China is moving in a different direction than the rest of the world. And I've said if there is a positive surprise for the world and for China is that its economic growth could actually certainly be better than last year and maybe be a little bit better than expected. And if that happens, from a worldwide basis, China would be helpful in preventing the world from going into a worldwide recession. In summary, I think that we've reached peak inflation. It's likely to go down, perhaps not as fast as people want, but it will go down. And the Federal Reserve is likely to, I would believe what they say, that is that they want to be hawks. They want inflation to go down, and they're going to keep rates high until inflation goes down.
Hello everyone, welcome to SFC Markets and Finance. The global economy has faced multiple challenges in 2022. Entering 2023, what is the outlook for the global economy? Which countries might have more potential risks? What should investors do in the world of uncertainty? With those questions in mind, let's welcome Stephen Dover, Chief Market Strategist and Head of Franklin Templeton Institute, to join our discussion. Hello, Ms. Dover, glad to see you. I'd like to start with the global economy outlook. So it seems that multipolarization will be a new trend. How will multipolar world affect global economy?
That's a great question. And let me give you some framework for how I think about that and a bit of a long answer. So I had the opportunity to first visit China and study in China in 1982. And of course, at that time, there was no trade or very little trade between China and other countries. And so one of the great developments of this last 40 years has been the massive expansion of globalization and trade. One of the great economic miracles of history was the opening up of the global economies and the great wealth that created, of course, in China, but also in almost all emerging markets. So now we look at a place where globalization is not growing at the rate that it has in the past. And there's even some questions about whether we want to expand globalization or not. But I think the first thing is that, yes, globalization is slowing, but it's not dead or dramatically dropping or anything. In fact, America just recorded its largest trade deficit ever. So American consumers continue their love for buying things, including everything Chinese. So that's continuing. I think the second thing is that to the extent that there is a slowdown in globalization, a lot of that is more political than it is economic. And so it's going to be the political will of our politicians, whether we expand globalization and have more treaties or not in the future. Some people have said we're moving from globalization to regionalization, but I don't think there's really a whole lot of evidence of that. I think for a whole long host of reasons, it's in most countries' advantages to trade. Now, there has been something that's happened recently that is significant, and that is the pandemic, which really taught countries that they needed to have critical resources at home. And so that has created onshoring. And I think that probably a lot of marginal development globally will be onshoring, that countries will need to have a certain amount of strategic manufacturing done in their home country. But I would say that this last 40 years since I was in China has been a remarkable ride for the world and for China, and I would expect it to continue to grow, but not at the rate that it's grown in the past.
Surprisingly, the Eurozone avoided recession in the fourth quarter in 2022, and the US labor market still performed strong. Will global recession take place, as many economists expected?
Well, the short answer is yes. We think there's likely to be a global recession in the United States and in Europe. But going through what you said, first of all, speaking about Europe, it's been wonderful news that Europe's economy has been much stronger than many predicted, including myself. That's been a little bit of luck for Europe because they had a mild winter. Also, energy prices were not as high as possible. Europe has done an amazing job of transition from an oil-based economy to reducing the reliance on oil. A lot of that is through a natural gas transition, but a lot of that is towards green energy as well. So we're very pleased that Europe has been stronger than expected. That said, Europe has a lot of structural issues, including probably structural issues around inflation. So we expect inflation in Europe to be a bit sticky, and we also expect Europe to have a recession or to have a slowdown in its economy. This is particularly driven by Germany, which in many ways, the growth in Germany has been to manufacture based on relatively inexpensive hydrocarbons, oil and gas from Russia, and sell much of those products to China and other countries. And so both ends of that are going to be harmful for Germany. So Germany is going to have some restructuring problems in terms of how it restructures its future industry. In the United Kingdom has slowed down significantly. It's very hard for us to see what's going to be a positive path forward. We talked about globalization before. The United Kingdom, of course, getting out of Europe has overall been harmful for its economy. The next thing you asked about or talked about was the very strong labor markets, which we saw just in the United States. That was somewhat of a surprise, pleasant surprise, because it's always good to have more people employed rather than less. But it does put the Federal Reserve in a difficult situation because robust labor markets, especially if the prices of labor are increasing, tends to be inflationary. And right now, the Federal Reserve is trying to slow down inflation. So the implication of that is that the Federal Reserve will have to raise interest rates more than many people anticipated, which of course increases the chances of a recession in the United States. So recession in the United States, recession in Europe, China, if I may say, and I can talk more about China later, is coming out of the COVID epidemic rather robustly. And so China's economy, which was slowed down over the last year or even 2 years because of COVID, now a lot of that pent-up demand provides some opportunities in China for growth. So China is moving in a different direction than the rest of the world. And I've said if there is a positive surprise for the world and for China is that its economic growth could actually certainly be better than last year and maybe be a little bit better than expected. And if that happens, from a worldwide basis, China would be helpful in preventing the world from going into a worldwide recession. And the last thing I would say on that, which is a little bit dangerous thing to say, but all predictions are that this would be probably an earnings recession or a mild recession, that company earnings would probably drop. The GDP would probably drop, but not severely, although obviously a bigger recession is a risk.
You have just mentioned that a bit, but what are the main challenges for global economy in 2023?
Well, I think that the biggest challenge for the global economy is that the nature of the economy is going to change from the last 10 or so years. So after the global financial crisis, interest rates were lowered dramatically in most parts of the world. And so there's lots of money, lots of liquidity, and that stimulated the economies, that grew the stock markets. But we're coming to the end of this global low interest, low inflation, high liquidity environment. So what that means is that the economy going forward will look different than the economy over the last 10 years. So how might that look different? Inflation will probably be higher, more 1 or 2% higher in the United States, meaning 3 or 4%, but 1 or 2% higher in other places. Even Japan, which has had 30 years of deflationary government, now looks like it will have inflation as well. If we are to look at Europe, Europe is doing massive restructuring of its economy. And a lot of that restructuring will be around the environment and sustainability. And as I mentioned, Germany needs to restructure. A lot of emerging markets, for example, in Southeast Asia and in Latin America, are more stable than they have been in the past and have a lot of opportunities for growth going forward. So lots of challenges for the global economy. The first is getting through inflation. The second is getting through a potential recession. But there could be a positive outlook if you look forward 3, 5, or 10 years.
In January meeting, the Fed raised the rates by 25 basis points, slowing the pace of its rate hiking progress. But the Fed signaled it will keep rising rates. How many times will the Fed hike rates this year?
So I think that right now, at least in the United States, there's a conflict or a kind of a disagreement between the markets and between the Fed. And so the Fed is saying that it's very hawkish, meaning it's going to fight inflation. And the markets, particularly in the last couple of months, are saying, well, you know, we think you're going to soften things and reduce interest rates. So there's an old saying that I think is good for all of your listeners to know, and that is you don't fight the Fed. That's an investor saying. But right now, investors are fighting the Fed. So the direct answer to your question is that I would say that, in my opinion, the Federal Reserve really wants to be tough on inflation. So they need to now increase interest rates at least 25 basis points at the next meeting, probably 25 basis points at the meeting after that, and maybe a couple 25 basis points after that. Even if I'm wrong on how many increases they have, I think the next important thing is how long will they keep interest rates high, or when will they pivot? And I think that it could be on into 2024 before they actually drop interest rates. And that is tied to the strong labor markets and really strong economy that they have. This Fed does not want to repeat the mistakes of the Federal Reserve governors of the late 1960s and early 1970s. Didn't finish the job in the sense of really tamping down inflation. So I think inflation will be conquered, or at least it'll be brought down to, let's say, a 3% level or so. I don't know if we'll get to the 2% level, but that will be done with a pretty tough Fed. So that's the debate that is happening right now.
What factors will affect the Fed's decision this year?
Yeah, so I think that if last year's discussion was all about inflation, perhaps this year's discussion will be a little bit more about recession. So the United States Federal Reserve is unique compared to other Federal Reserves in that it has what's called a dual mandate. It's supposed to fight inflation with a stable money supply, and it's also supposed to maximize employment. And an economist will tell you those are two opposing things. So right now, the Federal Reserve is focused on fighting inflation. And as long as the labor market remains strong, it's very hard to see the United States falling into a recession. In fact, some of our economists think the United States won't fall into a recession at all. and will be able to ease inflation without too much of a recession. That's sort of what the market is thinking at this point. But the Federal Reserve is clearly looking at the labor market, and as long as the labor market is strong, the Federal Reserve does not need to reduce interest rates. And unless there is a fairly significant recession, also the Federal Reserve does not need to reduce interest rates. So, as I mentioned, this level of very low interest rates that we experienced over the last 10 years is probably an anomaly, and we're not likely to see that going forward. In summary, I think that we've reached peak inflation. It's likely to go down, perhaps not as fast as people want, but it will go down. And the Federal Reserve is likely to, I would believe what they say, that is that they want to be hawks. They want inflation to go down, and they're going to keep rates high until inflation goes down.
So if the Fed stop hiking rates or cutting rates, how will this influence other countries?
Well, that's a good question. And as you know, there's the old saying that when the United States sneezes, the rest of the world gets a cold. And so what happens in the United States certainly has a very profound effect on other countries. And so the dollar was quite high last year. And that is probably good for America fighting inflation, but not very good for foreign countries, because it's a way of actually taking inflation out of the United States and putting it in other countries. It's not as simple as that, but that is kind of how it works. So we think that probably the dollar peaked, has peaked, it's come down. And so that will have a big effect on other countries. So a weakening dollar will be positive for foreign markets. So one of the recommendations that we are making now is that investors look outside of the United States for investment opportunities and invest. For example, we think Japan looks better than it's looked in a long time. Southeast Asia and many emerging markets look better than they've looked in a long time.
Will other major Western countries follow the Fed's pace to end rate hiking progress?
I would guess so, yes. I mean, every country is different and they have to fight their own inflation. But if the United States is successful in reducing and hopefully stabilizing inflation, then that will have a ripple effect in other countries as well, yes.
As we see, the Fed also repeatedly stressed that interest rate will remain higher for longer and will not cut rates during the year. Should market price in the Fed will keep its hawkish stance for much longer, and why?
Just first of all, I mean, I think we all know this, but last year was a terrible year for investing in stocks and in bonds. In fact, the only thing that maybe did do well was the US dollar. So foreign investors in the US did relatively better in their own currency. But it's the worst year for the combination of dollar and equity, which usually have some negative correlation with each other. That's why you have a balanced portfolio. So I think that going forward, you shouldn't give up on a balanced portfolio, that negative correlation is likely to happen again. So let's talk about fixed income and bonds right now. Yes, the Fed may raise rates another 50 basis points or so and may wait a while to pivot. But overall, for a longer term investor, it probably makes sense to get back into the fixed income market and to have some duration. Depending on the risk tolerance of the investor, for a US investor, we recommend that they invest in US Treasuries, which are quite safe. Those people who are in cash need to be certain that they could have put the cash anywhere before because it didn't matter because there was no interest rate. But now that there is an interest rate, you really need to be quite careful and make sure you're getting a good return on your cash, which you probably haven't been thinking about for the last 10 years or so. From a global investor perspective, we are actually quite positive on some emerging market debt. because we think that with the dollar falling, some of the local currencies will appreciate. Plus, many of those local currencies pay a pretty good interest rate. So that makes sense. So the real tip that's happened this last year is with rising interest rates, it makes fixed income a relatively better investment than equity, because you had a year ago or a year and a half ago equity yields higher than fixed income yields, and now the reverse has happened, and you can get your income with less risk from fixed income. Within equities, which for a long-term investor still makes a lot of sense, you probably want to look at value investing, which on a relative basis probably still has a lot of opportunity. But income investing in general, we think makes a lot of sense. You probably shouldn't neglect technology investing or growth investing, especially for those companies that are going to increase productivity over a period of time. I think you need some stock picking within that to do well.
After a very volatile year, the US stock market tried to rebound in January. Will a bull market take place this year?
Well, I'm a little skeptical about a bull market, meaning really the market roaring up a lot. So if my scenario of how the economy rolls out tends to be true, then the stock market would probably anticipate that before it actually happens. But that said, it's a little bit difficult right now to see a bull market in stocks because earnings are likely to continue to drop. I think one of the really interesting points is that revenues are up, but unit sales are down. So that means that companies have been able to pass on inflation at high costs. So they've made more money by selling fewer things. Even though they've had labor costs have increased, they haven't increased as much as revenues. So I think that's likely to reverse, and companies are going to have a better match between their units they need to sell and how much they charge. And if they do that, then earnings are likely to drop. So we think earnings are likely to drop about 10% more than the market anticipates. The second thing is, I talked to you about this last 10 years and all the liquidity of the last 10 years, and that liquidity has supported the markets, and that liquidity is drying up. That's what the Federal Reserve is doing, is taking some of that liquidity away. So that is not there to support the markets in the way that it has been in the past. But I'm talking about the United States market. And we do think that there could be a really good and positive market, as I mentioned, in Japan, in some parts of Southeast Asia. China's had a good start to its year. And as I mentioned, China has the possibility of surprising on the upside.
The earnings season is almost ended. The big tech earnings hit in the last quarter, and a lot of layoffs happened. Would you like to tell us the reason behind it?
Well, I think the reason behind it is what I said before, that even through 2022, revenues increased a lot. And so companies were above their revenue targets. And so because of that, they hired more people than they really needed. But the number of things they've been able to sell actually has dropped off. And ultimately, those two, usually revenues and net revenues, meaning revenues after inflation, are close, but they're spread. So I think that seeing that their revenues drop is what's caused layoffs. I think there's a lot of headlines about technology layoffs, and certainly technology is laying people off. But if you think about it, industry outside of technology has found that the people they need to run their technology units have been almost impossible to hire, because, of course, everybody wanted to go work for a technology company. So yes, those technology companies are letting people go, but what it shows is they're immediately being hired by consumer companies or other areas of the market which really needs those technology people. So in short, the technology companies hiring got ahead of themselves. They're not letting go of nearly as many people as they hired over the last year. And many of those people who've lost their jobs are having a pretty easy time finding new jobs.
So should we still buy tech stocks? If not, which sectors will have more opportunities?
The short answer is yes, you should still buy technology stocks because it's really an increase in productivity and growth that is what makes our economies work, and that's really, really quite important. I think you have to be selective of technology stocks and make sure that your technology stock is a technology stock that's really improving productivity in some way, as opposed to just a stock that is in essence a new way to gain advertising market share, and therefore very tied to the economy and risky if we're going to have a recession. So short answer, yes, lots of opportunities in technology, but you really need some guidance and help to pick the right technology stocks.
How about Chinese stock markets?
We're overall positive on the Chinese market. I think that said, you have to be careful which sectors you look at and where the opportunities are within China. My greatest hope, but not prediction, but hope, is that we have an upside surprise on the Chinese market. So if China really pushes economic growth and that's successful, then I think China could be the surprise market for an upside. You know, as I said, a long-term China bull and very positive on China. And so I'm really happy to see China opening up on a personal basis. And I think that there's a lot of opportunity there for investing as well.
Thank you, Ms. Dover, for sharing your views with us today. As Ms. Dover suggests, the global economy is facing many challenges, such as getting through inflation and potential recession. But if you look forward 3, 5, or 10 years, there could still be a positive outlook. That's all for today's show. Thank you for watching. See you.